Hello, good afternoon. You have tuned into CNBC TV18 and you're watching Mutual Fund Corner with me, Vinnii Motiwala. I'm in the Mumbai studio. At a time when the markets are seeing volatile movements coming in, it is imperative actually to go back and check your mutual fund portfolio. Whether you're starting off also, it's going to be important to see how should you start your portfolio, how should you build your portfolio at such a tough time. Now, that is what we're going to be talking about and addressing in today's show. How viewers can address the volatility, how often should they rebalance their portfolios, how should they start building their portfolios now. To talk about this, we have special guests joining in with us on the show today. We have Kalpesh Ashar, CFP-RIA at Full Circle Financial Planners and Advisors, as well as Jimeet Modi, founder and CEO at SAMCO Group, joining in with us. Very good afternoon, gentlemen. Thank you so much for coming to the studios, and it's a pleasure having you both on the show.
Thank you.
Now, let's start by talking about this important topic, because every time I look at the market, sometimes I'm wondering, like, okay, if I've already started, what should the strategy that one should follow, given that you're seeing such volatility that is coming in? How should you balance your risk and reward, selecting the funds? That's going to be important in such a market, right? Kalpesh, starting with you, what is it that a viewer should be looking at right now?
Okay, so thanks, Vinnii, for having me on the show. The times in which we are living right now, volatility is the name of the game, and we all have to live with it. And especially when you are in a market which is so full of participation and a lot of, I would say, inquisitiveness of everyone that what's going on. At that point of time, I think coming from the financial planning, school, I would always advocate that one should make a portfolio which is based on its goals. So a goal-based strategy, while creating a portfolio, will always stand you in good stead. And what I mean by building up a goal-based strategy and a portfolio which is in sync with it is nothing but aligning your mutual fund schemes which are in sync with your financial goals. So if you have a goal which you have highlighted to be coming up anything between, say, today to the next 3 years, there should be no second thoughts, but all the investments which you have got for that goal should be in debt funds. Because there's not going to be that type of volatility and you have to live within that range of returns, but there is no risk. Second, if you have a medium-term goal, which is again timeline-wise a 3 to 5 year time frame, then there could be a mix of debt funds and hybrid funds. And your advisor could advise you what could be the proportion. But still, if you see, the word equity doesn't figure there. But anything beyond 5 years, if that's your horizon for a particular financial goal, then majority of the chunk of your portfolio should be dedicated to equity-based mutual funds, diversified mutual funds, and more importantly, also have some portion of it in hybrid funds or little bit of debt funds like an hedge. So a goal-based strategy, I think, is the answer to the risk and reward which a person would derive, and probably let him, sleep in peace while the volatility carries on.
Absolutely. That sleep in peace and getting proper sleep at night is the key to any investments or anything that you do in life. But Jimeet, strategies that you would suggest also to an investor, what is it that you would tell them?
So I think there are two parts to this. First is, I think the way we look at it is you need to make sure that irrespective of your horizon, you have something that is called as a strategic asset allocation. And then you have a tactical asset allocation. No, the strategic asset allocation is you decide what asset classes you want to be invested in from a medium to long-term perspective, and that part of the asset allocation by and large remains static. It's only the tactical asset allocation piece that you keep moving around basis market volatility. Now, if you look at how performance of various categories, asset classes have done in the past few years, I think a good thing for from a tactical allocation perspective would be for investors to sort of relook at moving some funds from the extremely risky buckets of, let's say, a mid-cap, small-cap to a slightly more diversified pool. Because if you see, there has been a massive proliferation of folios and funds in both the mid and small-cap categories. So I think in times of volatility, after a great rise and rally, it makes sense to move and reallocate, rebalance part of your assets from risky assets, as I said, from mid and small to large caps, or if you're in only equity oriented assets, move part of your assets to hybrid oriented assets like Kalpesh was suggesting. And that's how you have to look at it. And I think the strategic part of your portfolio, I think that by and large should remain constant. Those are things that you should not end up tinkering with basis market volatility. Otherwise, you will end up doing too much rebalancing, too much tax incidence, which will, at the end of the day, result in a net effect, a negative effect for your portfolio.
Absolutely. So, Kalpesh, do you think now, like you were mentioning also debt fund, equity fund, and you gave the timelines of how one should be keeping a mix. Now, in the current situation, if I am, looking at my portfolio, is it time to actually start prioritizing more debt funds, or how should one look at it? If today is the situation where we saw, the first week of Jan seeing so much volatility, what is it that one should do?
Okay, so assuming that still the horizon is long term for an investor, I'm talking of a hypothetical situation. Because the markets have been so much on an upswing and so much of positivity and expectations have been generated in the last 3-4 years, and it's given above average returns, I think more than people have expected what they would give, and running against all the negativity which was prevailing. You had wars and whatnot. In spite of that, last 3-4 years have been completely a upswing.
Yeah.
Now, given that scenario, without sounding pessimistic, pragmatically, it could be that this year could be a little bit of a breather.
Yeah.
Or you could not expect that type of returns. Again, I'm not a analyst, or I'm not making predictions. I'm just going by probably something which could happen. And if that were to happen in the life of a long-term equity investor, I would suggest that a little bit of consolidation and a strategy, I would say, evolving is required, in the sense that whatever investments that person would be putting could be through the STP and surely through the SIP route, rather than making some very wild and obnoxious calls that everything is going to go fine in this year. I think time to be a little cautious. Continue with your equity allocations, but through the STP route, and obviously the SIPs need to be continued, because this is the time, in case if there's I would say a downturn or a negativity, your SIP would buy you more units. So this is the time to collect more units.
True.
The values will come later on.
True.
So that is part of the equity allocation. And debt, if again you are an equity investor, there has been a lot of expectations on debt which have been built up because of the rate cut, which is still not happening. But debt could still form a part of your core portfolio to whatever extent I think would be an appropriate hedge.
Okay. Jimeet, how should investors at such a time, if there is turbulence in the market, actually look at asset allocation method also, right? We have gold mutual funds as well. There's so much that has come in terms of an asset allocation format. What is it that, you should be looking at in terms for that strategy?
So see, I mean, if you are a beginner from a mutual fund perspective, and if you are just starting out investing in mutual funds, and if you don't know what is the right asset allocation for you, then I think probably first get in touch with an advisor, get in touch with a CFP, get your asset allocation in place, and then make these investment calls, move to the next step, which is selecting the schemes. If at all you cannot probably afford a CFP, and if you decide to go direct, then a lot of mutual funds also now offer asset allocation products within categories itself. So you have the balanced advantage fund category, or the dynamic asset allocation fund category. You have the multi-asset allocation fund category. These categories typically operate as multi-asset categories, which automatically do the job of asset allocation from an investor's point of view. So, if you're a beginner, you don't know what you want to do, you'll be better off starting with these hybrid categories really, and then moving on. If you're very evolved, and if it's been a few years of your mutual fund investment journey, and you've been investing for the past 5, 6, 7 odd years, and your objective is wealth creation, then if your objective is wealth creation, it should not matter what happens with a 10% correction or a 12% correction. It's quite meaningless. You stick to your asset allocation. If you've decided that I'm going to have 30% multi-caps, 20% large caps, or 20% small caps, then you stick to that. There's no need to unnecessarily tinker with those allocations just because there is an 8-10% correction in the market. So I think one has to decide what stage of their life they are in. What is their objective with investment? So is it maintenance of wealth, making sure that you are taking a conservative approach? Then you'll sort of move towards more debt-oriented assets, more hybrid-oriented assets. But if your objective is wealth creation, and you've designed an equity-oriented or a hybrid-oriented plan, then stick to it, and then there's no need to unnecessarily tinker with every 10% fall, because markets are going to fall 10% invariably every 12-18 months. You can't keep moving around every 12-18 months because I'm panicking with what's happening with the market. So you've got to take a long-term view, stick to your plan, and if you can't make your plan yourself, go to a financial planner and get that built for yourself.
Sure. Kalpesh, coming to the same question with you, asset allocation, importance of that, for a new investor at such a time, what would you suggest?
Huge. I think asset allocation is the heart of an investor's portfolio. And here, many people I completely agree with what Jimeet has mentioned, all the points, and not repeat them. But one thing, here, Vinnii, I'd like to point out is many investors, even evolved investors in a bull market, tend to confuse asset allocation with diversification. So a person would say, just for example, that, I'm diversified. So when you ask him, what is your diversification? He'll say that I'm diversified into large cap, mid caps, and small caps. But he still doesn't understand he's in the same asset class, which is equity. And he tries to feel that he's diversified, but not into anything else. So he doesn't have fixed income in his portfolio, neither does he have gold in his portfolio, which actually is a complete non-relative to the equity market. So asset allocation needs to be specified and nailed into a person, that you need to be in different asset classes which are not related to each other. And that is where this multi-asset allocation funds or a balanced advantage funds come into picture a lot. And if you can't do it yourself, like what he said, get professional help.
Yeah. On that point also, I just want to understand how important is also the role of international funds in such a situation also. Is it time that one should actually look at international funds, or, now we have those sector-specific thematic funds as well. Does that also count in and come into those sector allocations, or is it counted as a part of that equity side that we are already doing?
Yeah, so I just mentioned that. So that's a geographical diversification. If you ask me, international funds is a geographical, but under the asset class of equity. So the content doesn't change, the risk reward doesn't change there. So international funds is good. If you're in the equity thing, you want to diversify in that, but again, don't get carried away because it's just international name attached to it. Understand in which demographics are you investing, which countries are you investing, and what is the exposure given to each of the sectors there, because equities globally is the same way it works everywhere. So if you don't have sufficient knowledge, then again, mutual fund is good, international fund is good, but again, I would say don't have it more than 15 to 20% in your portfolio just for the name international.
Absolutely, because that sometimes, you are like, okay, maybe I may just invest in that market through the mutual funds.
People tend to get swayed. And that is where the role of an advisor comes to, hold the horses back.
And your thoughts on international mutual funds as well in the part of your portfolio?
So I think, like Kalpesh mentioned, I think you should not have more than a 15-20% allocation. Also, I think international investments and international funds are more suitable for an evolved investor who's already reached a certain stage and is willing to sort of take additional risk. I don't think for by and large most people you need to sort of go and take that additional diversification. So at best 5-10% allocation. In any case, now allocating into international funds via the fund route is sort of restricted because of the RBI ceiling of 7 billion. So to that extent, yes, but even while, let's say, if it were to open up, one should not go all out and say, oh, I'm going to only invest in NASDAQ ETFs or NASDAQ fund of funds or so on and so forth. You've got to have a balanced approach. Make sure that exposure is restricted to 10-20%, and that's about it.
Okay. On that note, viewers, we're going to slip into a very short break. Don't go anywhere. We'll carry forward the conversation on how you should be making your mutual fund portfolio, keeping it balanced, and adjusting the risk to the factors of market volatility after this break as well. Welcome back to Mutual Fund Corner on CNBC TV18, and keeping it going with the conversation with Kalpesh as well as Jimeet. Gentlemen, the next thing I want to talk about is also in terms of active and passive fund. What should we be watching out for at such a time? In a volatile market, what is it that is normally preferred, or what is it that one should look at, Jimeet?
So I think again, the difference between active and selection of whether you have to go for an active fund or a passive fund depends on the category that you're typically investing in. So, passive funds are great and so are active funds. But I think what you need to make a decision on is that depending on which category, let's say you allocated 10% to large caps. In that particular category, there is empirical evidence to show that passive funds may have done slightly better than active funds. Whereas when it comes to small cap funds or hybrid funds or multi-asset allocation funds, actively managed funds which have a slightly more dynamic approach have done better than passive funds. So there is no right or wrong black and white answer when it comes to the argument of active versus passive. Again, passive funds are great for people who understand, have their own plan, and they understand where they want to put, how they want to allocate their money, and they may just go direct picking passive funds. Whereas, sometimes if you're still, as I said, starting out, still nibbling, trying to figure out what you need to do, a financial planner or an advisor may recommend a mix of active and passive funds. So that again, as I said, you have a balanced approach, and in categories where passive works really better, you have passive exposure. In some other categories, you have more active exposure. But as I said, there is no right or wrong answer as to you only do active or you only do passive.
Your thoughts, Kalpesh? The financial planner is here for us as well to tell us on that.
So if a financial planner were to answer this question, I'll do best what's for the client. And that's actually in his interest, that a goal-based scheme would be selected for him. But just as a tactical strategy, like what Jimeet said, supplementing it, I would simply say that if we know that the benchmarks have been beaten in the large cap space by the passive funds, I would still give active a chance, because you never know which side the ball swings. So say for example in a large cap, I would want to allocate 100 rupees. I would still buy one active fund and one passive and give 50-50 to both. But surely small cap and mid caps, I trust our Indian fund managers and Indian AMCs to do a good job of stock picking, and more importantly, for the retail investor who's trying to get into the small and mid cap arena, mutual funds is the best way, because they are shielded, they are cushioned by a lot of research which goes into an AMC, and they would at least do a better job out
Absolutely.
there.
I think, if I may add one point here, I think what's important is also to understand that nowadays a lot of active funds end up implementing index hugging strategies. So what they end up doing is they end up having 70-80% similar portfolios to indices, and then so I think investors must look at a metric called as active share. And when they are looking at active funds, they should make sure that they're actually investing in an active portfolio which is different from the index, and actually getting their money's worth when they're paying a management fee to an active manager by virtue of having a slightly higher active share.
Sure. Kalpesh, you spoke about SIPs, right, and investing, and how it becomes, when the markets are too volatile, it makes sense sometimes because you're averaging out the price and SIP makes a deal. But what about lump sum? Does it make sense to do lump sum investing at such a time?
Yeah, it does, because when there is a person as a planner, if I see that he has got this money with him right now, and suitable to it, again, if the markets are showing some type of indication that this is really, I'm not trying to time the market, but this is really 10-15% from the lows, and the client or the investor would be better off keeping the money in funds rather than keeping it in a savings bank account. I think a combination of these 2-3 factors would call for a lump sum investment. But again, if you make a lump sum investment as a strategy, I would probably again supplement it in the time to come with an SIP. Because you don't know which side that lump sum would go. So even if you have a lump sum made, and if the markets were to fall, you have an STP or an SIP to again buy further units into that particular fund.
Kalpesh, your thoughts coming in on thematic funds, systematic funds. What are your thoughts on that front to have that in your portfolio?
So again, when it comes to thematic funds, there are two types of thematic funds. One is what they call diversified thematic funds, and in that case, again, it may make sense to have a 5, 10, 15% allocation to diversified thematic funds, let's say like a low variance fund or a momentum fund. These are all thematic fund categories, a business cycle fund. which offer a slightly different strategy as compared to standard diversified funds. I think what an investor should probably try and avoid are extremely thematic or fancy sectoral funds that are playing specific themes. You know, let's say if you're trying to play a defense theme or a railway PSU theme or a PSU bank theme, and because these kind of themes and these kind of sectoral funds will require you to sort of make sure that you get in, get out at the right time. They're probably best suited for a manufacturer rather than an investor. So, as I said, the investor has to probably make that differentiation of which are the really diversified thematic funds that could make some sense in their portfolio from a 5, 10, 15% allocation perspective, and avoid the ones that are, as I said, really fancy in nature. And what ends up also happening is that a lot of these thematic funds are often launched after some of the best performances behind. You know, so they end up marking top of the cycle typically, and I think we've seen that especially in the last year, where a lot of these specific sector-specific thematic funds have made.
That was the trend last year. 2024, every time I heard it, everyone wanted to only know about that.
Correct.
So that was surely the trend. But you know, given that such cases come in, what is it that there's a warning sign that one should watch out for? If I'm investing on my own, that, okay, in my mutual fund portfolio, maybe there's some risk that I'm exposed to. What is a warning sign that I should be triggered by, Kalpesh?
So two things here, Vinnii. One is, you know, when you see a portfolio and some person asks me that, is this a good portfolio? Is it prone to risk or what it is? Two things I would like to, you know, see here first. Does this individual have a penchant for NFOs? Because those are sold like hotcakes by the AMCs and the investors lap it up. Again, just thinking, ye kuch naya hai, you know. Whereas probably in most of the cases, it's old wine in new bottle, okay? And they just clutter up the entire portfolio, and there is evidence to it that nothing happens in that. And the second one is like what Jimeet said, and the last question was cluttered with too many sectoral funds. So if that is the case, you know that this person is acting like a herd mentality and doing what the entire, you know, the environment is doing around him and not looking at what is right for himself.
Absolutely.
So that is a big warning sign in any portfolio. Because ultimately, what is mutual funds, Vinnii? Mutual funds are nothing but a diversification of all your equity done in a professional manner. Now, if that is going to be concentrated or if that is going to be the same thing in an overlap, you're not doing justice to the mutual fund definition itself. So that's, I think, the biggest red flag which you could see in a portfolio. And one more thing is too many funds. So you could have a person doing 25,000 SIPs, 25,000 rupee SIP per month, and he could be doing it in 10 different schemes. It just doesn't make sense because he's just overlapping the portfolios and adding to his cost, and more importantly, losing his peace of mind.
True. Jimeet, quickly, we are absolutely out of time, but quickly, how often should one review their portfolio, and how often should you rebalance your portfolio?
So I think typically you should review it every quarter, once every quarter, and the sweet spot from a rebalancing perspective should be once every 12 to 18 months.
Okay. Okay, cool. Thank you so much, gentlemen, for joining in with us on the show. It's a pleasure having you both and understanding how one should be building their portfolio. But with that, we are absolutely out of time on this edition of Mutual Fund Corner. Don't go anywhere. Up next, Closing Bell.